Going back to gold real quick before we move on, because this sort of, we're still in the quad 4 risk discussion.
Yeah.
The problem with gold in the initial transition, we called this out maybe a month ago or so, is that when you initially transition from quad 3 to quad 4, especially in the current market regime where interest rates have been very volatile, they've been trading in a very tight range on the 10-year specifically. That initial transition where crude oil starts to break down carries break-evens lower, and ultimately you have this bounce off the lows in real interest rates.
Yep.
Now that's not a sustainable bounce, but it does obviously, is what we've witnessed over the past 6 weeks, creates a lot of consternation in gold, creates a lot of consternation in tech stocks, which are obviously inversely correlated to the direction of real interest rates as well. A lot of folks I had calls with, this summer, kind of thought, okay, once we start to see real interest rates break up, we're going to see, tech down, but value, financials, all the kind of negative momentum basket constituents rising. That has not been the case. These things are absolutely getting smoked because, again, quad 3 is not a conducive environment to go buy this stuff and rotate just because Wall Street wants you to rotate. Don't rotate because of that reason. Rotate because of the economic conditions tell you to rotate.
Yeah, basically what they did, and this is a major mistake, is that they basically took...
Huge mistake.
They took a lower high as a new trend. Mm-hmm. They drew the secant, as you affectionately call it many times, because it's a mathematical term, not an emotional one. They basically took a chart that said, okay, this thing, real rates, basically collapsed, right? So it's real interest rates basically look like something like this.
Yeah, minus 100.
So that's real rates,
basis points.
And the inverse of that is gold. So during that period, what did gold do? It went, right? So because one is the inverse of the other. So this is real interest rates. Going lower is the catalyst for the GLD or gold. Okay, so that's good. And then the thing goes up. Right? So then you get a little of this pin action, a little squiggly, right? You get a little squiggles. This thing starts going like this.
Mm-hmm. Because break-evens are going down.
Yeah. What is that? That's a period of like 2 to 3 months of you getting sucked in. Mm-hmm. Remember Robies, my buddy, my junior hockey buddy? Robies, you sucker! Or he suckered you in! Because guess what happens after that? The trend goes back down. So this little squiggly starts to go like this. This is basically phase 2 of the U.S. economy, quote unquote V-shaped recovery. Then it goes, ooh. What if that happens? I don't know if it's going to be that, but it's definitely not this. Mm-hmm. All right, that's the quad 2 portfolio. That's the economic recoveries here. I'm long financials. I'm short gold. I'm shorting treasury bonds. I mean, we talk a lot about the short-term issues that people have executing our process, because that's what, it's real money, I get it. You're agitated when everything doesn't work all the time. My all-time batting average in gold is like 89% in real-time alerts. So when it doesn't work for a couple days, you're sitting there like, oh my God, it didn't work this time, I have problems, he's got problems, we have problems, the process, good, I gotta go back to moving monkeys. No, absolutely not. This is the real problem that people have, all right? You're down 22% year-to-date, Steph. Yeah, she started calling the financials special situations. They are special indeed. If we do this, again, if Biden and Trump both say, hey, dude, MMT, and we collapse the yield curve from here, like flatten it, pancake, there's no curve. Banks go buy a Japanese bank stock 20 years ago with that about to happen for 20 years, and you tell me how that went.